It's 1999. A man quits his steady job, a good job, because he's making more money in a week trading internet stocks than he made all month at work. His neighbor did it. His barber did it. Everyone's doing it. Any company with .com at the end of its name is exploding. It doesn't seem to matter what they sell. It doesn't seem to matter if they make a single dollar of profit. You buy it, it goes up, you feel like a genius. 18 months later, that man has lost almost everything. Not because he was stupid, because he was standing inside the biggest market bubble in living memory and couldn't see the edges of it. I'm Mr. Finance. Today we're breaking open the .com bubble, how the whole world convinced itself the rules didn't apply anymore, how trillions of dollars vanished, and why I'm telling you this exact story right now, in the middle of the AI boom. Because the pattern is old, and you should know how to recognize it. No fear-mongering, just the anatomy. Here's the trap that makes bubbles so dangerous. They usually start with something real. The internet was real. It genuinely was going to change the world, and it did. Nobody was wrong about that. That's exactly why the mania worked. When the underlying idea is true, it becomes almost impossible to argue with the excitement. Say, this is getting crazy, and someone points at the real world-changing technology and calls you a dinosaur. But watch this next move carefully, because it's the whole game. The crowd took a true statement, the internet is the future, and quietly swapped it for a very different statement. Therefore, any company with a website is worth a fortune. Those are not the same sentence, but in a mania, they blur into one. So money poured into businesses that had a slick website, a clever name, and almost nothing underneath. No profit, often no real plan to ever make a profit. Investors stopped asking the boring question, how does this company actually earn money? And started asking only, how fast is it going up? Let me give you the flavor of how far it went. There was a company that sold pet supplies online. It spent enormous money on advertising, famous, expensive ads, became a household name in months, and went public to huge excitement. It was losing money on almost every order it shipped. Within about 9 months of hitting the stock market, it was gone. Bankrupt. There was a grocery delivery company that raised a staggering pile of money to deliver food to your door. A good idea, decades too early, and burned through nearly all of it before collapsing. The idea eventually worked for other companies 20 years later, but the ones who tried it first mostly died, and the tell was always the same. When a business couldn't point to profit, it invented new ways to look valuable. Look at our website visitors. Look at our growth. Look at how many eyeballs we get. Anything except the one number that actually matters over time, money kept. When you hear a company measured by everything except profit, your antenna should go up. That was true in 1999. It is true today. Then, in the year 2000, the mood changed. There was no single trigger anyone can neatly point to. That's how these things go. The buying just slowed. And once a bubble stops inflating, it doesn't sit still. It deflates fast, because the only thing holding those prices up was the belief that they'd keep rising. The main technology index lost around 3/4 of its value from top to bottom. 3/4. Trillions of dollars in paper wealth gone. Fortunes people thought they'd made, salaries people had quit, retirements people had bet, evaporated over about 2 brutal years. And here's the cruelest part. Many of the people who got wiped out weren't reckless gamblers. They were ordinary people who joined late, who waited until the story was on every magazine cover and every dinner table, felt safe because everyone was doing it, and put their money in near the very top. In a bubble, the feeling of safety is highest at the most dangerous moment. But the story doesn't end in pure ruin, and this part matters most. Because the internet was real, a few companies didn't just survive the crash, they went on to become some of the biggest businesses in history. One online bookstore fell something like 90% in the crash. 90%. If you'd owned it, it would have felt like the end. And yet it lived, because underneath the hype, it was building something genuine, and today it's a giant. So the crash didn't kill the internet. It killed the companies that were only a story, and it spared brutally but truly the companies that had a real engine underneath. The bubble was a filter. It sorted the businesses that made money from the businesses that only made noise. That's the lesson that survives the decades. A real revolution and a smart investment are two different things. The technology can be world-changing, and most of the companies riding it can still be terrible places to put your money. Both true at once. Before we get to today, let me hand you something you can actually carry around. The 4 signs that show up in almost every bubble in history. Not to scare you, to make you the calm one in the room. Sign 1. Everybody is suddenly an expert. When the people who never talked about money, your barber, your cousin, the person next to you on the bus, are all giving stock tips about the same hot thing, that's not a signal to join. That's a signal the crowd has already arrived. The easy money was made by the people who got in before it was a dinner table topic. Sign 2. Someone tells you the old rules don't apply. Profit doesn't matter anymore. This changes everything. You just don't get it. Every bubble invents a reason why the boring measures, like does this make money, are outdated. They never are. When you hear it's different this time, hold on to your wallet. Sign 3. People start borrowing to buy in. When folks take on debt or bet money they can't afford to lose because they're certain it only goes up, the whole thing turns fragile. Because the moment prices wobble, they're forced to sell to cover the debt, which pushes prices down further, which forces more selling. That's how a slowdown becomes a crash. Sign 4. The fear of missing out drowns out every other thought. When the only reason you can give for buying something is it keeps going up and I don't want to be left behind, that's not investing. That's the feeling that fills the top of every bubble. Notice it in yourself. It's the most expensive emotion in finance. Now the part you've been waiting for, because you're not living in 1999. You're living through the AI boom, and people are asking loudly, is this the same thing all over again? Here's the honest answer, and it's not a prediction. It's a lens. Some of what's happening in AI is deeply real. Genuine technology, real products, real money changing hands, just like the internet was real. But history says that when a real revolution shows up, a crowd forms around it, and that crowd stops telling the difference between this technology matters, and therefore any company that mentions it is worth a fortune. That is the exact swap that broke 1999. So you don't need to predict a crash. You need 3 questions. Does this company actually make money or just make headlines? If the excitement disappeared tomorrow, is there a real business left standing? And the honest one, am I buying this because I understand it, or because everyone around me is and I'm scared of missing out? Ask those, and you're already thinking like the survivors of the last bubble, not the victims. Okay, so you might be in a boom, you know the warning signs. What do you actually do about it? Because sell everything and hide is not the answer either. People who fled the market in fear have missed some of the best years in history. The honest answer is almost annoyingly calm. First, don't try to time the exact top or bottom. Nobody can, and the people who claim they can are usually selling you something. Second, keep buying steadily, a set amount on a schedule, through the ups and the downs. When you invest the same amount every month, you automatically buy less when things are expensive and more when they're cheap, without having to be a genius about it. Third, and this is the grown-up move, if you want to bet on the exciting thing, the hot AI name, the story stock, do it with money you could lose entirely without it changing your life, a small slice. Keep the boring core of your money in the calm, diversified stuff. That way, if the mania pays off, you win a little. If it pops, you're bruised, not destroyed. The people who blew up in 1999 didn't bet a slice. They bet everything. That's it. You don't have to predict the future. You just have to not put your whole life on one square. I'm not here to tell you AI is a bubble, or that it isn't. Nobody rings a bell at the top. If they could, there'd be no bubbles. What I can tell you is that the pattern is ancient, and now you can see its shape. A real idea, a crowd, the quiet swap from this matters to any price is fine, and a feeling of safety that peaks right before the drop. And the boring anchor that has outlasted every bubble in history. For most people, most of the time, a low-cost index fund you hold through the noise beats trying to pick the one winner in the middle of a mania. Bubbles humble the clever. They tend to reward the patient. Because here's the thing, history keeps proving. The internet really did change the world. The people who believed in it were right. They just paid the wrong price at the wrong moment on the wrong companies, driven by the wrong feeling. Being right about the future is not enough. You also have to survive the part where everyone else figures it out at the same time. The survivors weren't smarter than the victims. They were calmer. They didn't bet the house. They didn't borrow to chase it. And when the crowd was screaming that the old rules were dead, they quietly kept following them. So tell me in the comments, do you think the AI boom is 1999 all over again, or is this time different? I read The Smart Ones, and "this time is different" are famously the four most expensive words in finance. Take care of your money. Excitement is loud. Profit is quiet. Learn to hear the quiet.